Today I'm going to be taking a look at Andrew Peller, a wine producer in Canada. They trade on the TSX under the stock ticker ADW with both Class A and B shares. The Class A shares are non-voting and have the rights to a higher percentage of earnings and dividends. The only reason you'd be interested in the voting Class B shares was if you were building a controlling interest in the company. Before we jump into it here, a quick reminder to always do your own research and due diligence before making an investment decision. We're going to go over the following sections here where we'll look at what makes Andrew Peller an exceptional company and then what we think they're worth and what price we would pay for them. So Andrew Peller is a leading producer of wine and alcohol products in Canada with wineries in BC, Ontario, and Nova Scotia. In addition to producing wine and liquor, they also own and operate 101 retail locations and sell winemaking kits through one of their subsidiaries, Global Vintners. Seen here in the background is Peller Estates, one of their larger vineyards in Ontario, which was seeing over 250,000 retail visitors before COVID. In 1927, Andrew Peller arrived in Canada from Hungary and established his first winery soon after. From there, he slowly expanded and eventually passed the company on to his son, Dr. Joseph Peller, in 1970, who continued to expand the company's winemaking operations. In 1989, third generation John Peller joined the company, taking the reins as CEO in 1995, a position he still holds today. The Peller family remains the largest shareholder, with John owning 12% of the company. Andrew Peller is a family business, and they're always looking in the future, something that John Peller touched on in their last fourth quarter earnings call.
Much for that. We've got two next generation family members in the business, my son Jordy and my brother Gus's son Joey. And I definitely tell our people we got where we are because we plan for next generation, and we're making investments to strengthen our business going forward for the next generation, and hopefully we'll have the same good fortune.
Here's some of the brands on the screen, and we're looking into these guys. Naturally, I had to try a couple bottles with some friends, and for the most part, they were pretty good. I think Sandhill was probably my favorite. Something else Andrew Peller has been focusing on in recent years has been trimming down any underperforming brands and really focusing on their premium brands. And this is really paying off with them, with their margins getting a good boost along with increased sales. Looking at their management here, John Peller, their current president and CEO, and third generation of the Peller family working for Andrew Peller. He started his career off as a corporate lawyer before coming over to Andrew Peller, where he's been for 31 years. Steve Attridge, a newer member of the management team, only been with the company for 3 years, but he's got some extensive experience in the food and beverage industry. The rest of their senior management team here has been with the company for an average of 14 years. Something I'd like to see the management team work on in coming years is their presence in China. Andrew Peller entered the market in 2012, and with the middle class growing rapidly there, and as people hopefully develop a taste for wine, it's going to be a huge opportunity. Currently in Ontario, where Andrew Peller is based, the taxes on domestically produced wines actually favor imported brands. Usually this would be the opposite, and it's another good opportunity for things to change in favor of Andrew Peller in the coming years. Normalized earnings, sales, and cash flow have all seen steady growth over the last 20 years. They took a bit of a hit in 2008 on their earnings, but they weathered that storm fairly well, and 10% compounded annual growth since 2001 is pretty good for their earnings. Their sales and cash flow also growing at a decent clip here and consistently. Return on equity and return on capital have also been pretty good for Andrew Peller here. They're not very leveraged up, so these two rates are fairly similar, but they've both seen 2% and 3% compounded annual growth since 2001, which is good. You'd like to see that. I mean, the management has been working on their earnings power. And then another highlight over the last 10 years especially is their earnings margin. Like I said earlier, working on those premium brands has really helped their earnings margin, and I think it's really good for the company. Checking out their current ratio and defensive interval here, their current ratio has been pretty consistent over the last couple of years. Currently at about 1.6, which is they're not leveraged at all really, so it provides ample coverage over any short-term liabilities. The defensive interval has seen some steady growth, slow growth over the years, recently hitting an all-time high of just over 160 days that they could survive on zero revenue. Looking at some of their competitors here, Constellation Brands and Molson Coors are some of the bigger beverage producers in Canada. It's important to note here, this past year, both Constellation Brands and Molson Coors took massive write-downs in their brands, what they value them at. So their goodwill took a big hit, and this was reflected in the earnings statements for both of them. So in reality, their earnings were both negative by a fair margin this year. However, for this analysis, I decided to exclude them and provide here more of a normalized earnings for them so that we can compare them a little more fairly to Andrew Peller. Constellation Brands is doing pretty good with their return on equity, earnings margin, and their return on common equity. Having a look at their payout ratio, it's fairly in line, nothing crazy. They're trading at a pretty high valuation right now, 30 times their normalized earnings, that is. Molson Coors not doing nearly as well, and they're trading at a really high valuation, which tells us that kind of right now Molson is struggling a bit, but the market feels that this is kind of more of a bump in the road for them, that they'll recover here. Corby Spirit and Wine, this is much more closer to Andrew Peller in terms of size and general market. Andrew Peller is more focused on wine, while Corby Spirit and Wine are mostly focused on liquors, hard liquors. And just comparing some of their numbers here, Corby Spirit and Wine beats Andrew Peller in pretty much every category except for price to earnings and price to book, but still generally trading at about the same valuation here. Now, when looking into this originally, I thought, wow, Corby Spirit and Wine, they're doing really well. There is a bit of a catch. Andrew Peller is really focused on continuing to invest in their assets, and they're invest into the future, continue to grow both their book value and their future cash flows. While as Corby Spirit and Wine is, you can almost view it as sort of a cash cow right now. They're paying out almost all of their earnings, giving off a good yield, so they're not going to be growing a whole lot. They're going to be maintaining their book value as long as things continue to go well for them, but they're not going to be growing largely right now. So they're more of a cash cow. And I'm going to do a future analysis on them, I think, because I think there could be some value there. Mostly I'll look at kind of, growth stocks that are going to keep growing and really invest into the future. However, this Corby Spirit and Wine could be a good kind of intermediate term just to kind of suck as much cash flow out of that company as possible. Another thing to point out about those guys is that their parent company, they're owned by their parent company, owns the controlling stake in them, is the second largest producer of alcohol in the entire world, and so they reflect a lot of what happens here. So Corby Spirit and Wine has essentially licensed the rights to produce that company's liquors in Canada. So they've got the exclusive Canadian rights, which is where all of their kind of brand and all their revenue comes from. So largely influenced by their parent company. However, right now I would argue that Corby Spirit and Wine is fairly undervalued, and definitely be on the heads up for an analysis on them in the future. Checking out some of the defensive interval, again, Corby Spirit Wine is really killing the game right now. Molson is even lower than Constellation Brands. But Andrew Peller, looking at their stats, it's pretty solid here. I would argue that they're definitely beating in terms of value and just general statistics here. They're beating Constellation Brands and Molson Coors right now. Constellation Brands also has entered into the cannabis industry, and they took a huge write down on that this year. So it's been pretty bad for them this year especially. But Andrew Peller, pretty solid. Corby Spirit and Wine is beating them right now, however, even though they're trading at a slightly higher valuation. I think Corby Spirit and Wine is the clear picture. Looking at them right now this year, comparing them, if you were going to own this company for this year only, Corby Spirit and Wine would win this. However, looking far into the future, 10, 20, 30, even longer, 30 plus years, Andrew Peller is definitely, I think they're more set for the long term for sure, just investing in the future versus right now. Corby Spirit and Wine is purely focused on extracting as much cash flow out of the company as possible, which sometimes is the right way. And obviously their management has decided that that's the best course of action for the company right now. So definitely an interesting, but Andrew Peller holding its own across the competition for sure. Looking at some of their historical price to earnings here, right now we've just gone past over the last 20 years, and we've kind of find that right kind of sweet spot price to earnings ratio that Andrew Peller has liked to trade at over the last little while, and that seemed to be a price earnings of 15, which seems to be in and around what Andrew Peller likes to trade at, what the market generally likes to value them at. And so right here on this graph in blue, we've got their historical price since 2001, and then this yellow line is a price is what the stock would be trading at if they were trading at a price to earnings ratio of 15. And so when our price rises above this theoretical value, we think they're overvalued. When it dips below, we're going to say they're undervalued. 2009 here, a bit of an anomaly. They took a big hit in 2009 directly after they rebounded big time. So if you normalize these out, you'd see a much more line in line following closer to their price here. In recent years, though, Andrew Peller got very overvalued back in 2018. They had a big surge in earnings. Investors got a little excited, and they got a bit carried away here. Since then, it's come back down to earth. In March, along with the rest of the market, they had a little bit of a crash, very undervalued, and right now they're trading about right in line with what historically the market has valued them at. But so if we take their earnings today and we multiply them by a 15, we get our theoretical value. We think, according to the market historically, they should be worth about $11.70 today. So we're going to use that as our first kind of fair value valuation for them. Now we're going to look at valuing Andrew Peller both based on their future book value and both their future kind of cash flows that we're going to see as an investor, so their future dividends, and of course discounted back into today's dollars. This is just a plot here since 2001, their book value and their dividend, and we've gone ahead and plotted this in Excel, and then Excel's gone ahead and generated a trend line for us. And as we can see here, at least it can be a bit manipulating here. Sometimes it looks like this is a perfect fit, but you have to remember this is over 20 years, and they've seen fairly consistent growth. But from these trend lines, we can see that they've had fairly consistent growth, and we definitely feel comfortable with kind of just extrapolating this trend line forward and using this as kind of a rough eyeball. Our best bet, nobody knows for sure what's going to happen, but they could go, book value and dividends could go higher, they could go lower, but we're going to go ahead and say this is our best bet at a fair valuation, a fair guess of their book value and dividend going forward. So using those two trend lines for the book value and dividend, we're going to go ahead and we're going to look at kind of the projected 10 years into the future, the book value and the dividends that were generated from those trend lines. After 10 years, who knows what's going to happen? So we're just going to assume that Andrew Peller is going to grow in line with GDP, the general market, at 3% a year, which historically GDP has grown at about 3% a year. And so the first 10 years you can see here is slowly going up. At year 10, their book value is going to be $8.69. Oh, sorry, that's their current, so it's going to be higher than that. But of course, we only want the discounted future cash flows because $1 today is worth more than $1 tomorrow. So we're going to discount these two values back. And the way we're going to discount those, we're going to use the 10-year Treasury yield, which we can view as our 10-year risk-free rate of return. And then so in 10 years, we think the book value is going to be worth $8.69 in today's dollars. And we're also going to think the dividend is going to be paying out at 35 cents in today's dollars. And to get our future 10-year value, we're going to say, all right, in 10 years, if we liquidate the company, we're going to receive $8.69. Again, all of this is in today's dollars. And then we're going to receive the sum of all the dividends that we would have received. And if we sum those two numbers, all the cash flows that we would have received and the book value at liquidation in 10 years' time, we're going to get a value of $11.83. Now we're going to repeat this for the 20-year value and the 30-year value. So again, after 2031, we're assuming they're growing in line with GDP at 3% a year. And we're going to do that same thing, except for our 20-year valuation, we're going to use the 20-year Treasury yield, and same thing for the 30-year. And then these are obviously trading at a bit higher, so that's kind of our 30-year risk-free rate of return is 2.24%, the 30-year Treasury yield. Repeat the same process. 30 years, sell out of our projected book value in today's dollar, plus all the sum of the dividends. And that's going to give us $16.97 and then $22.71. So we can see that these values are getting bigger, and that's definitely a good thing. That tells us that the longer we hold Andrew Peller, the more it's going to be worth. So that's a good thing. We can tell that they're growing. So say, for example, if this number was decreasing, well, then it would make sense to just liquidate Andrew Peller today and collect our book value. So when we see this number growing, it's a good thing for us. We're also going to go in and throw in our 100-year dividend value. And that's just taking, if we hold this stock forever, the book value doesn't matter. The only thing we're going to be receiving out of it is the current dividends. And so the way we're going to discount those future dividends is we're going to use the 100-year high-quality bond yield. It's something that the Federal Reserve of St. Louis puts out, and it's basically their best estimate of if there were a 100-year treasury, it'd be trading at 3.32%. So that's what we're going to use. And we're going to sum up all those cash flows, and we get a value of $14.89. Taking the average of all four of those values, because maybe Andrew Peller will be liquidated in 10 years, 20 years, 30 years, maybe 100 years. Nobody really knows, so we're just going to take the average of those as our kind of another good guess at what their fair value is going to be. And so that average gives us $16.60 as our kind of second estimate of what we think Andrew Peller is worth today. So if we now look at our two values that we came out that we were thinking were our fair values, $11.70 and $16.60, and we average those two, we're going to show $14.15. And that's going to be our best guess at what the stock is worth, what their fair value is. And we feel fairly confident in that number based on the analysis we've done. And so now we just have to decide, what price are we going to buy the stock, and when we buy it, what price are we going to sell it at? So in order to come at that number, we want to look at two things: the return that we want to shoot for, and the amount of time, how many years that we think for this stock is going to be able to take to get to its fair value. And so when determining that, we'd take our fair value, $14.15, and we'd divide it by 1 plus the percentage that we want to earn, our return, in a decimal form, to the power of how many years we think it's going to take to get there. So if we think it's going to take 4 years to get there, that's the top row on the chart, and we want a return of 10%, the left row, we're going to have to buy the stock at $9.66. And so if it took 4 full years for the stock to reach its full potential, $14.15, we would earn 10% return at an annualized rate. And so when we look at this, usually we live 3 years. 3 years seems like a fair amount of time, ample time for the stock to reach its full potential. And then we want to shoot for a 15% return. That's what I usually shoot for. So if we look at that 3-year column, 15%, we're going to arrive at $9.30. We would buy this stock, and we would be earning a 15% return if it took a full 3 years for this to reach its full value. Now, of course, if it took only 2 years to reach it, we would be earning a higher return than 15%. And now we also want to decide at what price we're going to sell this at. Before I even buy a stock, I want to decide, what price am I going to buy it at what price am I going to sell it at. And then I can put my orders in, I buy, or it goes through, and then I can put my sell order in, and I don't have to think about it. It takes all the emotion out. I have my buy value, my sell value that I both come at in a, thought out analytical process. And so our sell value is going to be, usually I like to say, if this stock gets 25% overvalued, so 25% above the fair value, I think we can, if we sell that stock, pay our taxes, and reinvest it somewhere else, we're going to earn a higher return than if we had just held the overvalued stock. So 25% above our fair value is going to be $17.69 is what we're going to sell it at. And now it's also important to notice that these numbers are going to have to be updated fairly regularly. After every quarterly earnings report, this fair value is going to change, which is in turn going to change our buy and sell value. As our earnings reports are released, it's going to affect our trend lines that we came about, and it's going to reflect our 15 times price to earnings valuation. What's also going to change this is a change in treasury yields. So if treasury yields are changing fairly rapidly, or they change, a fair amount, say by say 0.10%, then we're going to have to go in and update, and that's going to change our current today's dollars from our future book value and any cash flows that we receive. So two things definitely keep in mind, because say if we buy this at $9.30, this quarter our sell might be $17.69, but a year's time from now, this value is hopefully going to be going up. Their fair value is going to be going up as new earnings and book value are released, and so this sell value is going to keep shifting up and up. And that's ideally, we want to hold this stock forever unless they become so overvalued that we feel we can get better returns somewhere else. But that's all I've got for you guys today. To sum things up, fair value, $14.15. We're going to buy at $9.30, and we're going to sell at $17.69. Thanks for listening in today.